Washington meets Wall Street. Some economists are warning an economic slowdown is on the horizon ahead of the 2020 election. I spoke exclusively with former Vice President Dan Quayle this weekend, who says the economy will play a vital role in 2020.
I don't know what the state of the economy will be in 2020. It's good now. We're a long way away. Nobody can really predict what it's going to be in 2020, and the economy is obviously key. President Trump ran on that, bringing jobs back to America, increasing wages for the workers. It's all good right now. What's it going to be in 2020? If the economy slips, then it'll be a real challenge for President Trump.
My next guest does not predict a recession in 2020, but says I expect a slowdown for sure. Joining us right now is the head of equity strategy at Stifel, Barry Bannister. Barry, it's good to see you. Thanks so much for joining us.
Thanks, Maria.
How significant a slowdown would you expect?
You know, we had a economy that's doing 5.5% nominal GDP, so that's the real portion plus inflation. I think that's going to decelerate to about 3%. And industrial output, industrial production grew at about 6% at its peak, and I think that'll fall to about 3%. This is normal as the cycle matures. You'd have a slowdown, but it doesn't necessarily mean a recession.
Is the market trading that way in your view? Are people making bets based on the expectation that things will slow down?
You know, one of Alan Greenspan's comments over 20 years ago that was very interesting was that the U.S. can't remain an oasis of prosperity in a troubled world. As the Fed is removing dollar liquidity from the world, you're starting to see the effects abroad. The process of policy normalization of raising interest rates is also very difficult. And as a consequence of that, what you find is the U.S. is starting to feel some blowback from that. And that is pulling us back in the growth rate.
Which brings us right to the story that you brought up earlier, Dagan, and interest rates, and what this gap between the 10-year and the 2-year is telling us.
Right. So the 10-year yield close, you pointed this out, below 3% for the first time. And the 2-year to 10-year gap, the yield curve, it's the tightest gap, the most narrow since 2007. And so, and you pointed this out, between the 3 and the 5-year, those two inverted. So the shorter term is higher than the slightly longer term rates. And generally that's a sign that investors are worried about economic growth prospects. So they're buying longer term treasuries as protection, if you will. And I'll just point this out because Lindsay and I were talking about it in the green room. I've said before, during this entire recovery, during this entire cycle since the financial crisis, every time the 10-year yield got to about 3.25%, it was a buying opportunity. And you would see people pile into it, and it would come right back down. And it kind of ebbs and flows with the economy.
So I think the question really is this this change we're seeing in the longer yields, the 10-year, is it related to growth concerns versus an investment opportunity in the short end to avoid investment or interest rate risk?
Yeah, we've been very bullish on the 10-year. We thought at 3, we would peak out at 3.25. I think we peaked at 3.24. I actually think it's going to 2.65. And net, that would probably be favorable, for example, for housing, where incomes are still strong. There isn't an excessive amount of inventory, and affordability has been a big issue. But when we look at it, the interest rate pullback is the inflation component, what's called break-even inflation. And as well, if the Fed is not going to be that aggressive with rates, the real yield, what's called the TIPS yield, it's also going to pull back a little bit. It's going to go below 1. So that's good. I think it's actually a good stimulus for growth. It's a counter-cyclical move.
So what does that mean for markets? Bridgewater Associates founder Ray Dalio was with us last week, weighing in on this very subject. Listen to this. Well, you just said you don't think that the Fed is going to be able to tighten much more. Are you saying that you don't think the Fed's going to be raising rates consistently next year?
No, I don't think the Fed will be consistently raising rates next year.
What do you think?
I think that what's in the curve, I think if they continue to raise rates faster than is built into the curve, that will affect all asset prices, because all asset prices have that one interest rate. You know, an asset is the purchase. It's the present value of a cash flow. When you buy an asset, you pay a lump sum payment for future cash flows, and there's a discount rate. That interest rate affects all assets. So stocks compete with bonds, compete with cash, which competes with real estate and private equity. And all of those. You raise the interest rate faster than is built into the existing expectation in the curve, and that has a negative effect on asset prices.
But is that the impact of a slowing economy?
Well, to a degree, oil prices had run up so much, and there's plenty of supply. The president pushed back the Iran sanctions for 6 more months, and that release valve of excess supply caused oil to fall. So, you know, on the one hand, that's a really good question. On the one hand, the U.S. has become a big oil producer. So if you have a lower oil price, there's less industrial output related to finding oil. On the other hand, it's a tax cut for consumers. And so it's kind of a mixed bag right now. I wouldn't call it positive or negative. It's kind of a slight positive at most.
What are you seeing on the trading desk in terms of where people are allocating capital right now?
Yeah, well, we have been favoring staples, healthcare, utility, telecom, a kind of a bond proxy and defensive trade. And I sense that more and more investors have been amenable to that as the FANG trade and other tech favorites have started to fade. I do think there's a little more left in that trade because I expect interest rates to come down on the long end, the 10-year.
So what do you think, in fact, speaking of interest rates going down, how do you think that impacts commercial real estate, and what's your outlook going forward into 2019 for commercial real estate?
Yeah. Commercial real estate, CRE, has been under some pressure. However, one of the things that we are fairly favorable on is the employment picture. We think the employment will continue to be full employment. We're looking for 250,000 jobs on Friday. When you add that up, you know, the jobs, the office space rental, the retail sales, the income getting better, but not at an excessive pace, should be relatively favorable, certainly for some of the risk side, meaning the default rate, and that would attract more capital.
This is your business.
Right.
What do you think?
Yes. No, I agree with him. I think also what he pointed out in terms of the outlook for the housing market going forward, that's what we're seeing in the industry, that we're optimistic. There are pockets of markets that are very soft, especially on the high end, like in New York City, because it's been oversupplied, and pretty much around the country, as affordability becomes, you know, more attractive. I think that's what's been slowing down our pace more so than the economy. Would you agree with that?
Yeah, and also don't forget the tax bill. Limits on interest deductibility affect at the high end because you're limited on how much you can deduct in terms of your mortgage, and you can't deduct the interest. So that did affect. But I think that, as anything in the market, the middle of the market is going to set the course because the high and the low end are really just tails. And I'm fairly optimistic on that.
Barry, it's great to have you on the show.
Thank you.
Thanks so much for joining us. Barry Bannister from Stifel.